One out of every $5 Americans spend on grocery goes to a single company. So roughly 90% of the country lives within 10 miles of one of the stores, which is Walmart, and it has raised its dividend every single year for more than half a century so far. Now, here's the strange part. So Wall Street is suddenly treating this as a 63-year-old discount chain like a tech stock, paying 40 times earning per ratio. So either the market sees something huge coming or has gone way ahead or itself. Today we're going to find out is which. So here's what we're going to talk about. So Walmart. So Walmart trades around $114 a share. It is worth about 909 billion as of right now, and it has briefly crossed $1 trillion earlier, not too long ago, this year actually. This is the biggest retailer on the planet as of right now, and probably the last name you think of when someone say a growth stock. That is exactly what makes the price so interesting. So we're going to go through the business, the numbers, the cash, and the risks. And by the end, you'll know whether this is still a buy. All right, so our latest news. So four things are worth knowing right now. First, there's a new person in charge. His name is John Furner. Took over as CEO in February, not too long ago, replacing Doug McMillan. Furner started as an hourly associate back in 1993, so this is a promotion from internally. Not really a shakeup. Second, Walmart crossed $1 trillion in market value, the first physical retailer to ever do it. Third, with AI pushing, it is real. Their shopping assistant Sparky now works alongside with ChatGPT, and the people who use it spend more than 35% per order. And fourth, prices keep going down while advertising revenue keeps going up. Those two are connected, and I'll show you how. So here's the whole thesis in 30 seconds. Walmart bring people in with cheap groceries, then makes real money selling advertising, memberships, and financial service on top of all that traffic. So revenue hit 713 billion last year, but the interesting shift is where the profit's starting to come from. So four things that really holds on to it. So what it is, the biggest grocer in America, what is happening? A pivot into higher margin service, the financial reality, thin retail margin but fast growing service layer, and the tension of $1 trillion price on business still mostly sell low margin stuffs. All right, so for the business model, Walmart runs in three pieces. Walmart for the US is about 69% of the business and the main profit engine. International is roughly sitting around 17%, and Sam's Club, the membership warehouse, also competing with Costco, uh, is about 14%. Now the moat is it is the scale, plain and simple. Walmart buys cheaper than most almost anybody out there, and it has 4,600 US stores, sits within the radius 10 miles of 90% of the country. So those stores double as delivery hubs that Amazon cannot easily copy, and the newer mode is data. So hundreds of millions of weekly shoppers are the audience that feeds a $6.4 billion ad business, which that they have. All right, so for the numbers, look at the trend. So revenue went from 648 billion to 681 to 713 billion over the last 3 years. So net income climbed faster from about 15.5 billion to almost 22. That gap really matters. Profits growing quicker than sales means that a mix of improving. The most recent quarter backs it up. So revenue is up 7.3%, net income up 19%, e-commerce is up 26%, and advertising is up 37%. So the higher margin pieces are growing 2 or 3 times faster than the store business itself. That is the entire story in one slide. All right, so how cash flow really works. So cash is where it gets interesting. So Walmart generates 41.6 billion in operating cash last year, which is pretty strong, quite strong actually. But then look at the capital spending. So nearly 27%, 27 billion, way up. They are building automated warehouses, remodeling stores, and pouring money into technology. That leaves about 15 billion in free cash flow. So here's the real tension actually. So free cash flow is being held down on purpose. The bet is that you spend on big now to build the automated machines and free cash flow expense later once the spending slows down. So investors are trusting the wave, which eventually will crest. All right, so for capital allocation, so three numbers tell you how they treat their cash. So again, 53 years of consecutive dividend increase, which makes Walmart a dividend king. A brand new $30 billion buybacks, the largest in the company's history, and 27 billion in capital spending. The biggest single use of the money is the philosophy is clear. Reinvest first because of automation projects, which is the moat. Then pay a small and but bulletproof dividend and quietly buy back the stock. The yield is actually under 1%, so nobody owns this for really any income for dividends. You own it because the company self funds a giant rollout and still rewards its shareholders on top. All right, so for the macro and geopolitics side, so the tailwinds first actually. So when the money gets tighter, the richer shoppers trade down, to Walmart, and a lot of them stay. A tariff ruling this year went into Walmart's favor, and several banks call it as a top pick, actually. And its scale let it eat cost shocks better than smaller rivals. Now the headwinds. So tariffs still raise the cost of imported goods, which really squeeze the margin for the retailer. A strain of customers, buy fewer of the high margin extras, and at this size, politically and regulatorily, attention never really goes away. The read is that Walmart is one of the few giants that can actually do well in a shaky economy, which is the one that we have right now. All right, so for the competitive positions. So this slide is really a reality check. So Walmart is the biggest grocer in the country, but its grocery shares slipped from 21.1% to 20.4%. And Costco grabbed most of it, what it actually lost to Walmart. The online is the bigger gap. So Amazon owns about 38% of the US e-commerce. Walmart right now sits around 7%, but watch the direction. So Walmart's online sales are growing 26% a quarter, and they're closing that gap as we mentioned earlier in the slides. Amazon is still far bigger by the market value, almost $3 trillion versus compared to like 910 billion. The edge is that Walmart keeps things physically. Nobody else pairs this many stores with these prices as of right now. All right, so for the risk, so there's actually four risks involved. The big one is obviously the valuation. So they're trading around 40 times the price to earning ratio. So any stumbles in these services, the story could compress. That multiple will be fast, and the stock falls even if the business is still fine. And another thing would be a medium risk. So capex, that's 27 billion as a bet that automation pays off. And if the returns come slow for some reason, cash stays pinch. And a medium is a competition. So Costco is taking grocery share, and Amazon owns online. And lastly, the medium would be tariffs. So tariffs and the consumer, which both hit the exact high margin mix of Walmart wants to grow. So try to notice the pattern. So the business risks are manageable, but the valuation risk is kind of the real one that we have. All right, so for the bull, neutral, and bear cases, so three ways to actually play this out. So for the bull case, the service flywheels keep spinning, automation lifts margin, and Walmart gets treated like a tech platform. The multiple holds the stock, and the stock will climb. For the neutral case, the business does fine, but not fast enough to justify 40 times price to earning ratio, so the stock trends like water while profits catch up to the price. Lastly, for the bear case, the capex does not lift its margin, competition bites, and a weak consumer hits in the mix. The premium unwinds and the stock drops even as the revenue grows. So your view on the multiple decides which one you believe. All right, so here's the bottom line. So Walmart is no longer just a place to buy cheap groceries. It is turning into a data and service business wearing a retailer's identification. And the market is finally paying for up for that. So the real question is whether the price is already assumes that the whole transformation is already done. So yeah, that's pretty much what I have for Walmart. But yeah, that's pretty much it. Thanks. Bye.